What does it take to buy a home currently in the current real estate market that we're in right now? We're going to talk a little bit about what it takes to qualify for a home loan and what it takes to actually get those keys to you, all that kind of fun stuff. We're going to go through the nitty and the gritty, and we're talking about it right now with Aaron. Aaron, how's it going?
Hey, what's going on, man? Good to be here. Yeah, this is something that, I talk to people all the time about getting home loans, and I've gotten used to it because I've been doing this for 20 plus years, but it's, a very common thing that comes up almost in every conversation. There's a lot of fear, a lot of doubt, a little bit of scarcity of, am I even going to qualify? Can I even get what I want? Can I even get a home loan to begin with? A lot of people have concerns about their credit scores or the type of job that they have. A lot of, a really common one I talk about or talk to a lot too is self-employed people. A lot of them don't think that they can get a home loan. So yeah, this is a fun topic. Let's dive in.
Okay, so we get a lot of calls from people who are looking to buy, of course. And some people who are probably watching these videos are thinking to themselves, you know what, my credit's not high enough. I don't have enough money in the bank. It's just like, it's a very much like, I equate it to almost like going to the dentist when you haven't been for a while, right? Like, 3 years and you're thinking to yourself, man, I got some issues. I got to go to the dentist. Or, like the IRS, where you're like, man, I got to file my taxes. I don't know what I'm in for. I don't want to deal with it. Now, if you approach it that way, you're thinking about it like in a kind of a different, in my opinion, kind of a different way. That you should be thinking about it more like it's a personal trainer, right? You're thinking to yourself like, okay, look, we got a goal right here. We got a goal in getting a house. Now, I might not be ready to actually do it, but at the same time, I want to know where I stand, right? Where you stand is vital in the real estate market as far as qualifying for a house, how much you can afford, how much you're making, all that stuff too. So the thing with reaching out to a lender, a good one, like a broker like Aaron, is the idea that he's going to let you know where you stand. Realistically, you might not be able to buy a house today. Realistically, you might be waiting for at least another year or 2 years, but at least you're on the right path getting towards your goal, if that is your goal. And that's the biggest thing. A lot of people that I've noticed, especially like in the Sacramento area and probably other spots too, feel that need of like everyone else is qualifying for houses because they have something amazing. 800 credit scores. They got money in the bank. I don't have that. There's just no way I'm worthy of buying a house. Maybe you've got a bankruptcy. Maybe you have low credit. Maybe you got that credit card at Havasu and you spend it all to go on your spring break trip. It happens. So what I'm telling you guys is like, it's one of those things where how you approach buying a house should be very much not like you're going to get a couple of teeth pulled. It should be more about like, where do I stand? I want to eventually buy a house. And what battle plan, what strategy, what, routine do I got to do to actually get this done? And someone like Aaron is vital for that, because sometimes you'll talk to people and he'll work with people for years, hey, look, we're going to do this and get you in a house eventually. And that's kind of what it is. So let's talk about this. Okay. Like, let's say that this video inspires, let's say Bob's, I don't know why I'm always going towards Bob, but Bob's the guy calling Aaron, and Bob's like, Aaron, like, I want to buy a house. Maybe not today, maybe not tomorrow. And I want to kind of work with you to help me to do that. Like, what does Bob need to do? What does that first step look like?
Sure. Well, I mean, besides just having an initial conversation where, we'd answer some basic questions, kind of get an idea of what Bob's goals are. Is he trying to buy a house, a condo? Is he single? Has he got a family? Just kind of trying to figure out what Bob's needs are. And then ultimately, Bob is going to need to complete a loan application, because until, we really look at the numbers, we see your credit, your income, all that stuff, we're just guessing. Like a lot of times, people will reach out to us, Bob will reach out and he'll be like, hey, I've got a 520 FICO score. Can I get a home loan? And the answer is like, maybe. I need more info than that, though. We need to dive in deeper and really, figure things out. So, whether it's potential credit, income, or just like made up fears that are in Bob's mind, which, to tell you the truth, a lot of times that's what the one of the big hurdles to overcome from getting qualified is that you've made up something in your mind that, it's like you mentioned the Lake Havasu thing, like something you did 10, 20, 30 years ago is like haunting you. And you think because of that, you're not going to qualify. I can't tell you how many times I've pulled somebody's credit and they thought their credit was going to be garbage. And they, of course, haven't looked at it for, years, decades or whatever. And they ended up having stellar credit or whatever. So, that saying, you don't know what you don't know. I mean, there's really no way of knowing exactly what you qualify for until you apply. Now, one of the things that I should throw out there is, let's say that you apply and you don't get approved. Does that mean that like you walk around with like the scarlet letter on your sleeve and like no lender will ever touch you or anything? No. In fact, nobody even knows. There's not even like a log or, that's just a myth that, if you get denied for a loan, you're in trouble and you'll never be able to get approved anywhere else. The reason I bring that up is like you've got nothing to lose by figuring out what you qualify for. And then once you figure out what you can qualify for, whether it's today, a year from now, 2 years from now, or whatever, you at least know, you have an idea of what home price should you be looking at, what neighborhoods, or, like a lot of people start shopping for a house and they don't even know what the payment is. And then they find out that either it's way more than what they could afford, or maybe it was less and they should have been stepping their game up, or they can't even qualify. So there's a lot of stuff that, Bob needs to figure out ahead of time. And that's where, people like me come in and, we do the pre-approval process with them.
Okay. So let's say Bob brings you, and I call it usually the 2x4, where it's like 2 W-2s, 2 tax returns, previous tax returns, 2 forms of ID, and 2 bank statements, so the last current ones. Is that enough right there to actually get it kind of like the ball rolling?
Sure. I mean, bank statements, W-2s, IDs, I think I said pay stubs, but basically where we can calculate your income, because part of it's figuring out what you can qualify for with your income. But then another part of the equation is if you need to make a down payment, if you're going to have closing costs, whatever the case is, we have to figure out, do you even have enough money to make the transaction work? And so looking at those things, the 2x4, as you call it, that gives us a good idea of where you stand. We like to go a little bit deeper than that and actually have you complete a credit report. We like to do soft credit checks. That gives us the ability to see your FICO scores, to see all of your trade lines, and also even run your application through like DU, LP, whatever. So we can really do a lot of pre-underwriting, basically due diligence up front, so that we're not just saying, all right, Bob, you're good at 500,000, but we haven't even pulled your credit yet. And then all of a sudden, you go fall in love with a house and it's time to do that and you don't qualify. So the idea, of course, is by the time you're reaching out to Mark and his team to actually go look at a house, you already know what it's going to cost. You already know that you qualify. Like there shouldn't really be any doubts in terms of like, can you get it? At that point, when you're actually out looking at houses, you're ready to pounce. In my opinion, is where you need to be. And the big piece to that is having the financing taken care of ahead of time, so that not only do you know where you stand, but you've seen this probably hundreds of times now, Mark, where a client sends you a message and they're like, hey, I saw this house on Zillow or your app or whatever, and I love this house. And you're like, all right, great. Are you pre-approved? And you're like, no, I haven't talked to a lender yet. Okay, well, you need to get that done. Call my guy, da, 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 da. And by the time, Bob, goes through the process, even if I'm, working at light speed, in this market, you lose a day or something, or 2 days or whatever. I mean, the house could be gone, especially if it's a turnkey, right priced home. You could miss out on your opportunity. So having your financing all dialed in ahead of time is crucial, in my opinion.
Here's the thing that I will say, a little side note on this, is that I 4 years ago, we'd be getting a lot of calls like that. As of now, we're not getting as many. I mean, people, I think, are a little bit wise to the idea that if they're shopping, the pre-approval definitely needs to be something that's already ironed out. A lot of people, we haven't run into actually a situation that the pre-approval goes south after we've shown as well too. Like, it's just, I think a lot of consumers, because of the information on the internet and everything too, are a little bit more like understanding of the process. I think maybe YouTube actually played a big part in that as well too.
Sure.
But I think that people realize exactly what they need. For me, the main thing is like this. It's like, and I'm just thinking, I'm trying to put myself in like Bob's shoes, and I'm saying to myself, watching this video, I'm looking at the wife, maybe she's having her first kid, or maybe I'm out of college. I'm saying, you know what? I hear real estate's a good thing. I don't want to be paying my rent. And so for me, it's always like one of those things where I say, like, I know I got to call one of these guys. I get it. But like, it's like, it's kind of like, how can I say it? Like, it's kind of getting the ball rolling, at least kind of like those stats, a 2x4 will at least give you some busy work to do. So you have at least something that it won't be like, well, now we got to get these from, you got to get this, you got to get this. It's like, it gives you at least a little bit of a basis to do some groundwork. For me, it's like, like just kind of understanding that what are the things that need to kind of start looking through to kind of get the ball rolling on it. A lot of times also, you'll be looking on Zillow and you'll see a house or the Sacramento real estate app, which you should be using. And you'll see a house and you'll be like, oh my God, like I said, I mean, real estate marketing is so crafty these days. One day you're looking for like a fold out chair at Costco. The next thing a real estate house pops up and you look at the price and you say, wow, that's way too good to be true. Maybe I can buy a house. So I would say that at least getting those 2x4s, getting those things kind of like getting those things actually, that's like a little bit of the busy work, right? It's kind of like if you're going to the doctor. Doctor will say, I need your 3 last years, your this and that and everything before you come in for your first visit. It's good to be prepared a little bit, so at least you have everything you're ready to go. Because honestly, like and this is one of the things that I'll say, if you just call, right? And I know it's going to be like one of those things where you'll talk to Aaron. He'll say, hey, I'm going to send you the app. Then I need you to put all this paperwork into the app. Now, if you don't got the paperwork ready and ready to roll, like, all of a sudden, that request could get sidelined a little bit. That request could be like, I'll do it tonight. I'll do it tomorrow. Do it the next day. So for me, one of my tips would be to you is like get your paperwork kind of ready to go. Get your stuff going. I mean, Aaron, for you, how many people have you sent the app to? All hot, ready to go. And like, how many times have that app kind of just fallen on deaf ears? And explain that app to us a little bit.
Oh yeah, no, it happens all the time, and I think that there's multiple reasons for that too. I think there's also kind of like that realization of feeling like you're now committing to this. Which, by the way, if you apply for a loan, like you're not committing to anything. Just eating up some of your time basically is all, and it doesn't take more than 10-15 minutes. As far as the application goes, it's all done online. And they're just they're asking, where have you lived the last 2 years? Where have you worked the last 2 years? How much do you make? But even if you make $1 million on the application, it doesn't matter, because what we're also going to ask for is like a copy of your pay stubs or your tax returns or whatever applicable to what you do. And we're going to calculate your income, because, consumers aren't very good at mortgage income calculation. They're good at knowing, how much money they think they make, but the mortgage industry, they go off of different, they use gross income, not take home pay, all sorts of different little nuances. And so we have to basically calculate your income based off of what's the lender going to give you credit for. But besides from, your residency over the last 2 years, your employment over the last 2 years, they're going to ask you about your assets, which assets would be liquid assets like checking, savings, stocks, bonds, 401k, stuff like that. Not like your, baseball card collection, even though that Willie may be worth like a ton of money, it's not liquid, right? So the assets, they'll ask you about your liabilities, but we're going to get a copy of your credit report anyways. And then at the end of the application, there's a series of questions they're standardized questions that are asked to everybody. But it basically asks, are you planning on living in the house as your primary residence? Have you owned any other homes in the last 3 years? They're trying to determine if you're a first-time home buyer, if it's a rental, all that stuff. Do you owe any taxes? Do you Have you had a bankruptcy, a foreclosure, things like that? And it's going to basically ask you to identify, any of those things. That's where, to be honest, a lot of people, they feel like, if I just check the no box here, they'll never know about it. And, maybe the bankruptcy that I had will never come up. And everything always comes up. So my advice is to check all the right boxes, disclose all the information, and let the loan officer, the mortgage person like myself, let us figure out how to make it work within all the various rules. Because what you don't want is to withhold something from your application. And it's almost a sure thing that the lender, during their underwriting and due diligence, they do all sorts of background fraud checks, all sorts of stuff like that. If you're hiding something like that, it's going to most likely come up, and you don't want it to come up and actually be something that keeps you from getting your transaction done. You want it to where, like, I want to know all the problems up front so that I can figure out what the solution is to them. And then we enter in the escrow already set up to win, versus playing defense after the lenders come back and they're like, whoa, what's up with, this foreclosure that, you didn't disclose. But the application process, like I said, takes 10, 15 minutes. It's not very difficult.
All right, well, let's go through some of the stuff, and I just want to kind of give Bob a little bit of intel so they'll know. As far as credit, how much does credit factor into as far as getting pre-approved? Guide us a little bit on a good score, bad score. You need to work on that. I mean, guide us a little bit as far as a credit score goes.
So I'm helping somebody right now buy a house with a 522 FICO. The lowest credit score that you can get a traditional home loan with is a 500 FICO. Now, if your FICO is less than 580, you do have to come up with 10% down. But if you're above 580, then you start, going into all the traditional products, like FHA loans. If you get to a 620 FICO, that opens up the doors to Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac care about your FICO score way more than all the other types of loans. VA, USDA, FHA, they don't really care about your FICO as much as, do you have the minimum score? Okay, great. Fannie and Freddie, they're going to penalize you for every 20 points your score is under 800. So if you're in the 780 to 800 box, you get a better deal than the 760 to 779 box, and so on.
Okay.
That also applies to your mortgage insurance expenses. So if you don't put a 20% down payment, you're going to pay more for your mortgage insurance for every 20 points your score is under that. But on a FHA loan, it doesn't matter if you got an 800 FICO or a 600 FICO. You're getting the same deal, basically. Although some lenders do like to charge people with challenge credit more, that's not an FHA thing. It's not required.
Okay. So that's credit. So you're saying, if you're above 500, there's a chance, and but getting your credit over 580 where you don't have to put 10% is a good way to be.
Yeah, and I mean, if you are interested in any of the down payment assistance programs, stuff like that, usually Cal HFA is really popular in the markets that you and I work in. They're going to want a 640 to up to 700 score, depending on what type of DPA program you're doing. But for the most part, if you have a 580 FICO, you can do a minimum down payment, 3.5% down, and get a regular old FHA loan.
Okay, perfect. All right, so that's number one. Hopefully that answered anyone. If you guys have any specific, also reach out to Aaron or just comment and question on these videos, because we answer everything that you guys do. Any questions you have, just let us know. So if there's something on the credit scope you're like, ooh, I didn't know that, can you guys elaborate a little bit? Just let us know, and we'd be more than happy to answer the questions below. Okay, so number two, let's switch over to employment. Let's talk about self-employment. Let's talk about how long you have to be employed. Let's talk about switching jobs.
Yeah. So being employed, they want 2 years of employment history, whether it's you're self-employed or you're employed. Okay. If you're self-employed, it gets a little bit more convoluted, but basically they want you to have 2 years of being self-employed. But for instance, I did a loan not too long ago for a guy that he worked for basically like a grocery store as a W-2 employee, and he was like he ordered all the stuff for the store. He started his own company doing that like a year later. And we were actually able to get his loan done with just 1 year of self-employed, but same line of work with more than 2 years of history in that line of work. So in general, they want 2 years of history. Now, if you're going to switch jobs, which happens all the time, although it can give your lender a stroke while they're trying to navigate everything if they don't know about it, it's typically not a big deal. But here's where it could be a big deal: is if you receive commission income, if you receive bonus income, stuff like that. Those require to be averaged out. So like the lender's going to take your last 2 years history of receiving that bonus and average it out. Well, if you just started working somewhere, how does the lender know what your bonus is going to be and what the history is of it? So depending on, what you're doing when you're switching, it can have a negative impact on your ability to qualify. But in general, if you're a nurse at Kaiser and you're transferring to go be a nurse at UC Davis, it's not going to be an issue. And that's usually what we see is like one industry, same thing to the same thing.
Okay, but what if someone is a realtor and they decide to be a YouTuber? So what happens if you switch career paths? Like career paths completely change. How does that impact your employment record?
Well, are you shifting to be self-employed or to be employed? If you're shifting to be employed, then we're still back to the whole, do you have 2 years of work experience, whether it's being employed or self-employed? Can we document that you've been working for 2 years? And if that's the case, and then you're going to go and take a job somewhere, a W-2 job, then literally all I need is a copy of the offer letter of your job. If you're receiving a salary, or if you're on an hourly wage, we just need your first pay stub, first 30 days of pay stubs, and we can use that income to qualify you. Now, if you're going to switch though, and let's say that you're a self-employed real estate agent, and now you're going to be a YouTuber or whatever, and the way that your taxes are filed is that you're no longer a realtor on taxes. You're now a content creator or whatever the case is. Well, that's going to be a problem because you don't have 2 years of history of being self-employed as a content creator, and the lender doesn't have the ability to basically document stability of income is really what their concern is. The other thing too to factor in, I mentioned, like if you were going to go start a job somewhere, I can use your offer letter for that job to qualify you, for your loan. Whereas when you're self-employed, unless we're doing a bank statement program or something like that, you're going to need tax returns. So if you just shifted from realtor to YouTuber or whatever the case is, and now all of a sudden, you got a year and a half before you're even going to be filing those returns. Well, we have no way of documenting your income. So that's where the job change can, become problematic.
Okay, I'm going to hit one more thing in employment, and then we're going to move on to the next. Okay, Aaron, I'm making like a bunch of money with Mary Kay. I got Herbalife. My family owns a tire company. All these different streams of income. Like, how does that factor in? Because a lot of people, we're running into a lot of people. People are hustling. They got side hustle here, side hustle there. I'm driving an Uber. I'm like doing DoorDash. Like, how do all these various, like, let's say like you're looking at someone, you're like, whoa, okay, so you made like $3,000 a month with Uber. You got $2,000 coming in from DoorDash. You're also, it seems like you're a full-time employee over here. Like, how does that hodgepodge of money coming in, which is awesome, how does that play into like getting approved, work history and all that stuff?
Yeah. So the whole 2 year thing is going to apply for all those. So like, let's just say that like you're a wicked hustler and you've got 5 different, jobs, and you're receiving a 1099 for all of those. Like you're self-employed. You're either literally charging, you've got your Etsy store or your Shopify or whatever, and you're charging, consumers directly. And then maybe you're doing some contracting work, and like Uber, they pay 1099, for instance. You're a contractor of Uber. So each one of those things, you need to have 2 years or at least 1 year and have been working in that like you would have been, for instance, a W-2 taxi driver. I don't think those exist, but just pretending you're a W-2 taxi driver for a few years, and then you transition to being a 1099 Uber driver for a year. Well, I can count that as 2 years of being, self-employed as an Uber driver. But your other 4 gigs, each one of those things, you're going to have a 2-year history, and you're going to file a schedule, most likely a Schedule C, or maybe you've got individual corporations for each one of those businesses. So there's going to be a tax return and a schedule for each one of those returns in your personal returns, and we would calculate the income on each one of them. And we can add multiple incomes. There's no limit to how many sources of income that you can have. It's just a limit of, is it eligible to qualify? Meaning, do you have a 2-year history of it, and can we document it somehow? Typically, it's with a Schedule C tax return is what I see most of the time, because a lot of the gig economy, a lot of the gig workers are all receiving a 1099, but because of what they do, it doesn't make sense to have an LLC or whatever the case is. So they don't have like a corporate return. It's just on their personal tax returns. They file a Schedule C, which is meant for sole proprietors.
Okay. All right. Well, that gets us to employment. Like I said, you guys, if you have questions or comments regarding the specific things that we're running into, either give Aaron a call, email him, text him. He's available. He lives for this stuff just like I live for real estate. He lives for freaking mortgages. So, I mean, call him up. He'll be more than happy to chat with you about it. But if you feel you want to be a little anonymous, just comment underneath about the specific chapter that we're doing, all that stuff. If you want us to kind of elaborate on what we're talking about as well too, we're here for you guys. And so if there's anything we can do to additionally like inform you, educate you, we're here for that. Okay. So we covered credit, we covered employment, DTI. This is a good one. Let's talk a little DTI. Let's go over everything DTI related, because this one's big. This has killed a few people.
This will definitely play a role in how much you qualify for, what you qualify for. If I'm painting with a really broad brush, basically when it comes to debt to income ratios, DTI, the lender will allow all of your monthly debts that show up on your credit report, along with the new mortgage payment with taxes and insurance, to add up to half, 50% of your gross income. And your gross income, if you're the gig worker that we were talking about, it's got 5 different, jobs that we can document and that are eligible. Well, when we add all those jobs up together, let's say that it was $10,000 a month. Well, 50% of 10,000, that's $5,000. So what a 50% debt ratio would mean is that all of your credit cards, car loans, and your new mortgage add up to $5,000 basically. Now, that does not mean that, and that's why I said paint with a broad brush, that just carte blanche, if you're under 50%, you're good to go. The way it works these days, and it's been this way for, I say these days, but it's been this way for the entire time I've been doing this for 20 plus years, is there's what they call automated underwriting systems. And it's just basically a computer program that's, gets better over time, that analyzes risk. And so literally we submit your loan application along with your credit report into this program, and it analyzes the risk and determines whether or not it meets Fannie Mae, Freddie Mac, FHA, VA, USDA, whatever thresholds, and whether or not it's approved or not. And sometimes, like we got a deal right now that, in fact, that guy with the 522 FICO score that I was just talking about, the only way that we could get a approve eligible, which is like the term you want when you run your automated approval, the only way we could get it to approve, we had to have his debt ratio at 31% or less. If it was at 31.01, didn't like it. If it was at 31.00, we'd get an approval. So Now that guy, obviously with a 522 FICO, he had, some skeletons in the closet, late payments, charge-offs, things like that, making him a higher risk. But in general, like if you've got great credit, you should be able to go up to 49.99 debt to income ratio. If you've got challenge credit, if you've got some other scenarios in your past, foreclosures, bankruptcies, things like that, that the analyzation of the risk, it's higher risk. You might be where you're going to be capped at maybe 45 or 35 or something like that. But for the most part, you can go up to 50. Now,
Okay.
If for all you guys fact checking me on Google, or you got OpenAI going or whatever, it is true that on FHA loans, you can go up to 56.9% on your debt ratio, but that's a back end ratio. Your front end can't exceed 46. And I'm so in the weeds, I'm not going to just go down there, but I just want to point that out because I know some of you guys are screaming at the screen right now that no, that's not right. So in general, up to 50.
All right. I like that. All right, T has a big one. So, okay, so we're on to this one. We're on to the Jerry Maguire. Show me the money. Money in the bank. All right, so a lot of people need money in the bank. Now, I'm going to step in just for a second here. You also got to factor in moving costs, like home maintenance, like renovations, all that stuff too, closing costs, all that stuff too. But as far as the mortgage end of it, okay, and like I said, if you guys want to know how much it costs to move into a house, you got my number. Just reach out, give me a call, and we can talk a little bit about how much. I always kind of like tell my clients that they should be saving for that kind of stuff. So feel free to give me a call. But let's talk on the mortgage end of this stuff. Like, what are we talking as far as money in the bank? You see a bank account. What are you liking to see there as far as like buying a house, as far as all that stuff goes?
So the lender. And the lender does not care how many times you go to In-N-Out Burger or, your Starbucks runs or whatever. That's one of the things a lot of people, like when they're submitting their bank statements, in the back of their head, they're like, oh God, like they're going to see that I went to Jamba Juice 5 times last week, or they could care less about all that stuff. They're not even looking at that. They're literally they're looking for a couple of things mainly, is any payments to the IRS that wasn't disclosed, non-sufficient funds fees, because that can show basically like, it's a risk, you're financially irresponsible potentially. And then they want to show that basically you have enough money to cover whatever the closing costs are for your transaction and whatever your required down payment was. So like, let's just pretend for Bob, his minimum down payment and all of his closing costs added up to $20,000 or whatever. If that was the case, then the lender would want to see that Bob has had at least $20,000 in his bank account, and that's the balance for the last 2 months. They're looking at the last 2 months. They don't care about the 90 days ago. The seasoning requirement is just last 2 months. Now, if they see large deposits, they're going to question them. A large deposit would be like, Bob works as a W-2 employee for Toyota, and Toyota direct deposits his paycheck into his account. Well, that's not a big deposit. What the big deposit would be is like, Bob's mom gifted him $5,000 because he was going to buy a house. And he deposited that check into his account. And that was $5,000 that did not come from Bob's employer. They're going to be like, hey, what's up with this non-verified deposit? And then that's where we would have to document, oh, hey, that came from Bob's mom, and we get a copy of the canceled check or those kinds of things. In some circumstances, though, when people move cash into their bank accounts, that's a big no-no. If you're going to do that 90 days away, and then it's not in your 60 days of bank statements. But if you do that in that 60-day time period and the lender sees those cash deposits or the deposits that we can't document, then at best, the lender's going to back those deposits out of your eligible funds, your eligible assets. Some lenders, though, they can be kind of, tough about it, and they'll be like, hey, these just aren't eligible at all.
Okay. All right. So I got kind of like a little bit of a bonus question as well too. A lot of the people that watch the channel also are either people looking for investment properties as well too. So what are the guidelines? What's the difference between the primary, second home, and your investment property as far as qualifying for, let's say you have your primary. Let's say you're saying to yourself, man, that's a lot, but I'm thinking about buying my second home or investment property. How do these things factor into those purchases?
There's two main things. Your down payment's going to be larger on a rental property versus your primary residence. Primary residence, you can go like basically zero down with a down payment assistance program and whatnot. You buy a second home, you need to put 15% down. And I mean, honestly, guys, if you're going to do that, it makes way more sense to put 20 to 25% down mathematically. The rates are just so much better if you can just get a little extra skin in the game. Same applies with your investment properties. And it just comes down to risk. The higher the risk, the more you're going to pay. And there seems to be kind of this sweet spot where if you can get your down payment to 25% on a rental property, like the pricing's so much better. It makes sense, like from a cash flow standpoint. But as far as assets go, two things here. On rental properties, you cannot use gift funds. So I was talking about Bob's mom gave him some money to help him buy his house. That's cool on your primary residence. That's even cool on buying a second house. However, you got to come up with at least 5% of your own money. But on a rental, it's all your money or no money. So you can't get gifts for a rental property. And then depending on how many rental properties you own and what Fannie Mae or Freddie Mac's automated underwriting results say, will dictate how much you have to have in reserve in assets. And the reserve means like extra money left over after you complete your purchase, after you pay your closing costs. You still have 50 grand in the bank left over. Those are reserves. And the minimum requirement for reserves is dictated by the underwriting results. Typically, you're looking at around 2 to 6 months of mortgage payments in reserve, depending on, how many properties you got.
All right. That's perfect. Okay, so now the big question. Bob has got, his wife just saw a house on Zillow. Oh my God, they fell in love with it, okay? So Bob got his 2x4 ready. And remember, guys, Mark's 2x4, what's that? Two of your last W-2s, 2 of your last tax returns, 2 of your last bank statements, and 2 proofs of ID. He got all those things ready, man. He calls up Aaron. He's like, I got everything good to go. Aaron looks at it. He checks it. Everything looks valid. Like, how long does it take to get that pre-approval letter? And how valid is that? I guess what I'm saying is, like, those Visa cards are like, you're pre-approved to $1 million. And then you apply and it's like, well, you got about $500. You're good with that. Like, sure. How valid is that pre-approval? And how long does it take to get it? And are there things that could change along the process? I guess there's where we're going with that one.
So, I mean, we sometimes bust those things out in as little as same day. I mean, it just depends on how complicated Bob's scenario is and how many additional questions we might have. And also like how bad Bob needs it to get out that day. Sometimes people want to go look at a house immediately and they need it done. So as far as things go, typically though, I'd say 24 hours, 48 hours, to get pre-approved. Your pre-approval, it's going to say it's good for 90 days. And that's because your credit report's going to expire, your income documents, those things expire. Now, realistically, as long as you don't go out and take on new debt and you don't quit your job or change your income or mess up your credit somehow, like you stop paying your bills on time or whatever, the only thing that can really change is the interest rate in the market. So if rates don't go up and they go down, you should qualify for more in the future, even after 90 days. But typically what you'll see is a 90-day expiration on those pre-approvals. But it's almost kind of indefinite as long as you don't, negatively impact your scenario.
All right, guys. Well, hopefully you enjoyed this video, guys. Like, comment, subscribe, questions. We're here for you. Aaron, any parting words?
If you want to get on my calendar, go to meetnewway.com, and I'll see you guys next week.
Okay, guys, hopefully you enjoyed this video. Like I said, we are doing this with Aaron every single Monday. Now, we're thinking about bringing back the live show, maybe in the morning at 10 a.m., maybe a little coffee show to get you primed for your week, or maybe even returning it back to either 5:30 or 7 p.m. at night. So let us know if you want us to bring back the live show. We do this just for you guys. All right, now, if you're thinking, I want more content, I bumped into this channel and this channel is working for me. Here's a video for you right here. And here's another one for you right here. And please subscribe when you get a chance as well, too, guys. This is Mark. Thumbs up. We appreciate it. Till next video.